I'm Stanley Leong with Susan Ng, and thank you for joining us here on Money Mind. Now, Asia has seen a jump in investments from foreign companies last year, a recovery from the pandemic-induced lows we saw in 2020. Now, China in particular saw a 20% jump in inflows to a record $179 billion US. However, this year, foreign investments in Asia are expected to remain below pre-pandemic crisis levels.
Yes, and to give us an analysis, we have with us Lennard Yong, who is CEO of Business Expansion Specialist Tricor Group. Lennard, thank you for joining us today.
You're welcome. It's my pleasure to be here.
Very good talking to you, Lennard. Start us off by talking about foreign companies and investments in Asia. What's holding them back this year?
Yeah, I think this year is going to be a very interesting year because in the prior years, during the 2019 to 20 and 2021, a lot of the US and Europe was slightly more muted in terms of foreign direct investments, whereas Asia continued to propel. But I think what you're beginning to see here is because of some of the macro fiscal support and also the widespread success with the vaccination in North America and also in Europe, there's an expectation that foreign direct investments in those regions would come back from a much lower base. And then consequently, you find that in Asia, because we've been a little bit more steady over the last 2 years, despite the pandemic, therefore relative growth levels may remain the kind of high single digits. Whereas in elsewhere, they might be, exceeding the double digits because of the lower growth base.
Right. Okay. And, we are made up of so many countries here in the Asia Pacific. Are there particular countries in Asia that saw higher levels of foreign investments last year?
Yeah. So based on the latest data, and there's always some time lag here because it's a tremendous amount of data collection from the economy. Mm-hmm. But in Asia specifically, I think you highlighted China. That's correct. China grew at very high double digits, and that has been one of the leaders in Asia. And China, there I include China and Hong Kong as well, which is essentially China's investments out offshore. Further down south, I would draw your attention to the wonderful triangle of Singapore, and then on its left and right flank is Vietnam and Indonesia. Those three economies are probably the stars within ASEAN, being the main beneficiaries of this more recent uplift.
All right. So Singapore generally doing well, and you say Indonesia and Vietnam as well. But for us here in Singapore, are we attracting enough foreign investments?
Yeah, I think Singapore is in a very phenomenal position because you've got very good infrastructure, global talent, and also I think a very effective commerce and infrastructure. And typically what we see with a lot of clients is when they want to make the investments into Indonesia or into Vietnam to set up primary, industrial manufacturing, etc. Singapore benefits by being the regional headquarters or the holdco for the infrastructure. So you have a holdco in Singapore and then an operating co in Vietnam, Indonesia. So in that sense, Singapore benefits as the financial center for these ASEAN investments.
Would you say it continues to hold a lot of promise moving into 2022?
I think so. We're making investments into our own business. We see our clients making investments into ASEAN via Singapore. So I think the prognosis is very positive and encouraging for Singaporeans.
I want to take you back to a point you made earlier, Lennard, when you talked about China. Why do you think they're attracting such high interest from foreign companies, from investors?
Yeah, so I think one of the most obvious things is that China remains the most indispensable strategic market. So if you're looking for a consumer market, and its GDP growth, it's really indispensable for a global multinational not to be a global number one without accessing the Chinese market. So I think that's first and foremost the most obvious thing. But let's double click a little bit. Over the last few years, you've seen the Chinese economy start to shift from essentially manufacturing into now services. And services is a broad definition which encapsulates technology and human services, financial services, and a number of things. So I think those have been essential stimulus to really attract new forms of investments into China. On top of that, as you know, China has been trying to be also moving into becoming more green and having a lower carbon footprint. And so by doing so, you see that, its investments and into, say, electric vehicles, etc., has been phenomenal. And with that, it's attracted a whole number of subsidiary services that come along with that and subsidiary investments. So I think apart from the large economy, some of the sectoral plays going to services and some of the shifts in its investment strategies going to, more ESG friendly kind of investments, I think has given the impetus for more and more investments to go in. Had they continued with its manufacturing game plan from the 90s and early 2000s, then I think you would have seen a result that was not so encouraging.
Lennard, just a quick word with you on property and tech sectors in China, though, because I think there are big question marks over these two sectors. There's actually greater scrutiny from authorities. Do you think this would deter companies from investing in these two sectors in China going forward?
Yeah, I think, in terms of the property sector, that is essentially most of the local Chinese developers that were building out your kind of commercial and residential, that has not attracted substantial amount of foreign direct investment. So I think that's mainly contained to the domestic players. With regards to tech, I think technology is quite exciting in China. And there are obviously, phases in which they're maturing in terms of, addressing some of the things around data privacy, information flows, etc. So I think it's just a natural part of a growing up of an economy where they are evolving their regulations to be able to better match what may already be prevalent on the Western Hemisphere. So I think it's a case where as long as the macro and the growth is still there, there's still a need to be able to use technology for humans, that will not stop.
And still, with an eye on China, Lennard, are there certain sectors, certain industries that you are seeing reporting a surge in foreign investments despite the pandemic?
Yeah, I think as I gave a little bit of a clue, I think I see potentially green and low carbon transformation. That's definitely a very big impetus, and we saw that as well in Vietnam, where the government was encouraging more green energy production. So that's always a new sector that plays very well. And in the whole shift from manufacturing to technology, there's a whole need to, redevelop the integrated supply chain. And China is trying to attract a global talent pool as well, because in services, you need, a whole different breed of software engineers, and services-oriented people, as opposed to in the past where you need, hardcore manufacturing.
We're speaking this hour on Money Mind with Lennard Yong. Lennard is CEO of Business Expansion Specialist Tricor Group. Lennard, there seems to also be a growing interest in special purpose acquisition companies, or SPACs. Your view on this trend?
Yeah, look, SPACs began in the United States, and it's been really exciting because there's been over 600 IPOs launched with, in excess of 160 billion US of the SPACs. And more recently, I think, you saw the first SPAC come out in Singapore, which was a company called Vertex, sponsored by Temasek. And incidentally, that came out a little bit ahead of the first SPAC that was filed here in Hong Kong on the 17th of January. So I think, the intense rivalry between Singapore and Hong Kong is bringing out the best in financial services in the two economies. And really have to, note that Singapore came out with the first one. SPACs are a very unique vehicle because if you're looking for an exit, often in exiting a company, there's a lot of uncertainty for the selling shareholders. There's uncertainty around timing and around price in particular. A spec essentially gives those selling shareholders the deal certainty and the ability to price very concisely. And so therefore, that's been one of the main drivers. So I would say spec is another toolkit in the investment banking portfolio to be able to assist companies find their types of exits that they're looking for, where timing and monetary certainty is essential.
Now, still on specs, is there anything you think investors, regulators need to take note of for spec IPOs?
Yeah, I mean, clearly specs in themselves are highly speculative, because at the point when they IPO, often the investments are held in a trust fund until they find the appropriate investment vehicle in which they will merge. And often there is a time period of about 1 or 2 years. If there isn't a business that they've identified in accordance with the prospectus, then there's usually a very compliant way where they have to unwind the spec, or they call it de-spec. So I think consumers who invest in this need to understand exactly what is the spec being set up, what sector or what industry that they are targeting, and therefore whether or not, as an investor, whether you have your own personal insights into that sector, and if that fits your investment horizon and suitability. So I think investors got to still go through the kind of needs analysis to ensure that what you're buying makes sense for your own personal portfolio first.
So from the investor, let's move on to business leaders and their main concerns. Of course, we're still reeling from the pandemic, and this is going to go on for a little while more. And one of the challenges really is economic stagnation. What can companies do to mitigate this?
Look, I think one of the challenges right now is that as COVID and we all hope for all humanity subsides quickly, there is a short-term drive for intense fight for talent, for resources, and consequently that's pushing up inflation in many jurisdictions, including Singapore as well. So I think one of the challenges now is that, if governments are wanting to rein in the inflation, may, adjust too quickly some of the interest rates, that may have a negative impact on some of the global growth that we've been enjoying. So I think businesses and leaders just need to build in that kind of scenario in their mindset that, we may live with potentially high levels of inflation or otherwise interest rates, and therefore make adjustments to your business case accordingly. And therefore, I think you're likely to see prices increase in order to be able to keep things sustainable. Second, I would say that because of this global dislocation, it's probably a great opportunity for businesses to further enhance and create your supply chain resilience. You saw that, in your manufacturing, there's a need to move things from A to B. And some of that has been hampered because of global supply chain and logistic challenges. So I think business leaders who are in that sector should really rethink whether or not they should, plant a different flag in a different jurisdiction, or have more resilience in their supply and manufacturing.
Lennard, I'd like to go back to one point you made about ESG, especially when we were talking about China earlier on. The E, of course, standing for environmental, and that's what we want to pose that next question to you about. Governments, we know, businesses, societies facing increasing pressure to transition to net zero economies, a rapid transition to cleaner energy. Of course, definitely a good thing for our planet. But will it cause some companies, you think, to maybe undertake very painful restructuring, which means that some workers could be, put out of jobs?
Yeah, look, I think globally, the infrastructure, our planet is still largely reliant on traditional forms of energy generation, mainly from gas and oil, etc. I mean, let's focus on the fundamentals. Mm-hmm. And hypothetically, if all of us wanted to buy green energy right away, there isn't probably enough, energy from the new green energy to be able to supply. So effectively, even if humanity wanted to move, let's say tomorrow, you couldn't. And so there is a gestation period of another 10 or 15 years of investments that are massively needed in order to create the kind of supply that is needed so that we can make those economic choices to go green. I think about the time when I was living in Holland, for a couple of years there, I actually bought energy from a green source in Holland, which came from the wind generation.
Yeah, windmills.
That actually, yeah, and I actually had to pay about 15% more than, say, traditional gas and oil. So I think in order to create the kind of mass transfer from people, we need to create more supply so that, the cost of, consumers making those choices won't be prohibitive, but really will become more encouraging. So I'm all for green energy. And I think that's the way to go if we want a more sustainable planet.
All right. We wish we had more time with you, Lennard, but time seems to be slipping through our hands like the hourglass, the sands in the hourglass. Lennard, thank you so much for joining us today and helping us understand more about FDIs, foreign direct investment flows into Asia, and also all that's shaking up global economies around the world. Thank you for joining us. Lennard Yong is the CEO of Business Expansion Specialist Tricor Group. Thank you, Lennard.
Thank you. My pleasure.